Bloomberg Audio Studios. Podcasts, radio, news.
This was a blowout number. I kind of feel like it shocked all of us. First quarter streaming paid net change in terms of the subscribers up 9.33 million. Tim, the estimate was 4.84 million.
That's not the only beat. First quarter EPS coming at $5.28 per share. Estimates were for $4.52. The company also out with second quarter EPS, the guidance $4.68 versus estimates of $4.54. And then another big headline we should note, they're going to end reporting quarterly membership numbers next year. We got a great group of folks with us right now to help us break down these numbers. Paul Sweeney is co-host of Bloomberg Surveillance. He joins us on the phone from New Jersey. Paul spent 30 years as a media analyst. Also with us is Bloomberg News earnings reporter Red Brown. Hey, Paul, I want to start with you because I got to tell you, I'm pretty surprised by the reaction to these numbers, considering it was such a blowout quarter. Why do you think the stock is moving lower in the after hours?
Yeah, I think it's a little bit by the rumor, sell the news. People have been hyping up this quarter as a really big quarter because, the paid subscription was going to fuel subscriber growth yet again here. They had a big beat on subs last quarter. So the stock was up about 25% since they reported in January. So it's probably just taking back some of those gains. But, across the board, the subscriber numbers really, really were impressive. One thing to note about the big subscriber beats the last couple of quarters, these are kind of short-term phenomena. As the people that were sharing accounts now are paying for their own, and that'll fade out over the next several quarters. And then the focus will become, I think, on the advertising side of the business as well.
Yeah, it's interesting. Do you care, Paul, to hear that they're going to end reporting quarterly membership numbers next year? Feels like it's something we focus on, yeah.
Yeah, it really is. And that, quite frankly, that had been the primary driver of this stock really since it switched to this digital streaming format. That was the metric that moved the stock. The company really wants to get away from that and get more towards, hey guys, just view us as you would any other company stock. Look at revenue, look at cash flow, look at profitability, all those types of things. And let's focus less on subscriber growth because, quite frankly, we pretty much everybody that's out there. So it's really not so much a subscriber story. It's more how much money can we make off each subscriber?
Paul, one more to you, and then I want to bring in Red Brown, our earnings reporter, who's been watching these numbers closely. Why would is there any positive way to read into a company like Netflix no longer reporting this? I mean, no question, the more data for investors, the better. This is a negative sign, no?
Oh, yeah. I think for an investor and an analyst, you always want more information, particularly when it's critical information in terms of what drives the growth of the business. And it's obviously it's subscribers and how much revenue you generate off each subscriber. It's pretty simple. So when you take one of those data points away. But we've seen other companies in other industries do that, particularly subscriber-based industries. They try to get you away from that number and get you back to look how they are managing the business. And what they're telling you is we're not managing the business to maximize subscriber growth. We're managing the business to maximize revenue and profit per user. That's our management focus. And that's how we look at it. And that's how we think you should look at it.
Red Brown, come on in on it. We talk earnings with you all the time. I'm watching Netflix shares that have been bouncing around in the aftermarket. A lot of moves. Right now, the stock's still lower, down about 3.5%.
Yeah, I mean, I think what might be explaining a little bit of the negative movement, too, is we saw them actually boost their full-year outlook for operating margin. They beat EPS in the first quarter. Their guidance for the second quarter was ahead of estimates as well. But it seems like there's a little bit of a disconnect between the full-year number. If, those two pretty healthy beats are not translating to the full year, analysts, investors might start to question maybe where in the back half of the year are things starting to slow down as well. So I think that might also be factoring in here a little bit to the negative price movement we're seeing.
But speaking a little bit to what Paul was saying, and I think it's a good point that we talked about it earlier, just, this stock has been on fire this year, and, it looks like the numbers are pretty upbeat, but it has been such an outperformer this year. And I just do wonder how much of that is at play as well. Yeah,
I mean, if you look at what analysts are rating for the stock, that it's kind of topped out at the analyst ratings point at this point. So, even with these really impressive numbers, maybe it's just kind of hit its ceiling for the time being.
Hey, Red, it's so interesting. I was saying as we were going into our Beyond the Bell, our coverage with TV as we, waited for these Netflix earnings, I was saying, this could really set the tone for the quarter for a lot of the consumer tech companies that are set to report in the coming weeks. And yet we get a blowout number pretty much across the board. and we see a negative reaction like this. And I'm wondering how we can extrapolate this beyond Netflix.
Yeah, it's a good question. I mean, people have been really focused on earnings this quarter, and a lot of analysts are saying, focus on the numbers, don't buy into the hype, and has really big implications for the stock market in general at the moment. So I don't know if people kind of are on edge and looking for any excuse to sell at the moment. It could paint a pessimistic picture for the remainder of the quarter here, probably for us.
Paul Sweeney, come on back in here. I'm just thinking, we're getting ready for the analyst calls, and I feel like there's going to be a fair amount of questions, especially as you see the stock kind of bouncing around here. What's kind of the top one or two questions that you would want to be putting up on that call?
Yeah, one revenue and one cost question. The revenue side is, talk to us about the advertising component. How well is that catching on with subscribers? How many subscribers are going to the advertising tier? And that's a big thing because that's going to be one of the drivers going forward. And then a second one on the cost side is, where are we on our programming budget? Do you need to spend more to drive more subscriber growth, or is a company at a good level of spend? Because if they are at a good level of spend, boy, the profits just really start churning for this company, and the free cash flow as well.
I do want to bring in some of the advertising information that you mentioned, Paul. In the letter, the company did come out and say that ads membership grew 65% quarter on quarter after rising nearly 70% sequentially in each of Q3 23 and Q4 23. They're also saying that over 40% of all signups in our ads markets, remember it's not fully rolled out, are coming from our ads plan. For advertisers, the company's focusing on measurement solutions, including new partnerships with Kantar and Lucid for brand awareness and recall, and then Nielsen Catalina solutions for sales lift. Paul, I don't have to tell you because you've been covering this for years. How wild is it for us to talk about Netflix and measurement? Because this is a company that for years was like, we don't care about ratings. We're never going to share any numbers. We're never going to do ads. Never, never, never. And here they are talking about Nielsen?
Yeah, exactly.
This is crazy.
It is. It's a great point. They're going to have to start disclosing audience levels to some degree. But we already know that the advertising video on demand model is a very successful model. Advertisers are switching from linear TV, broadcast, and cable to the more digital platforms. And they've been itching to get to the streaming base of Netflix. So there will be a lot of advertiser demand. And Netflix is going to have to provide the advertisers and their agencies with some data because just so they can just get a sense of pricing and value.
Yeah, and the other thing is I'm thinking about content, right? Original content versus licensing. And when we were talking with Geetha Ranganathan earlier, she said, one of the upsides is that they are, doing a lot of licensing deals. They had Suits. They just did something with Sex and the City. That's just coming out. I mean, when you think about it, Paul, as an analyst and somebody who understands the space, I mean, cheaper to do a licensing deal versus creating that original content?
It is, generally speaking, it is much cheaper to license a show than to create it, particularly the shows that they make, which are extraordinarily high quality, and they have very big budgets. Now, that's the investment part. The good news is it does drive subscriber growth. So I think most investors would say that's a good investment to make in original programming, but you got to find a balance here. And that's true for the media companies. They have to find a balance on what they license to Netflix and what they keep on their own streaming services.
Red, let's say you had a chance to ask management a question today on the call that's coming up. What do you want to hear about?
Yeah, I mean, we're talking about programming and what's going to be driving growth in the future. I think there's a big question around sports.
Oh, yeah.
What level of investment are they planning on putting in that area? We know it's highly competitive. It's really crowded. It's very expensive. They are kind of dipping their toe in with some of these combat sports. But yeah, it'll be WWE, the Jake Paul and Mike Tyson fight later this summer. We will want to hear kind of what is their strategy. They've been on the sidelines for a while now, and have they been able to see the mess that sports streaming has been from paying billions and billions of dollars? Do they have a different strategy like they have in so many other cases in the market?
I do wonder, too, and I'm just looking at something like a Walt Disney in the aftermarket. And obviously, it's not just about streaming. It's just down slightly, down about 0.1% here. Warner Brothers Discovery, same story. I mean, Paul, is there anything that you kind of extrapolate when you look at something like a Netflix and then what it means for some of the other streaming services that are out there?
I think it's actually all net positive, which is it just shows you the strength of the streaming business model. We now know, when you look at Netflix's financials, that it can be extraordinarily profitable, generate really high returns. So now the question is, who else can join Netflix with those types of financial metrics? can Disney do it? Can Warner Brothers Discovery? Can Paramount? That's kind of the question a lot of those investors are asking themselves. But it can be done here if you look at Netflix.
Listen, Paul Sweeney, thank you so much. We so appreciate it. Our own Paul Sweeney, who has covered the media industry and did as a banker for many years, 30 years as a media analyst. So really great to get his insight. We're going to continue with Red Brown. We're also going to roll into it our Geetha Ranganathan, who covers the media space for our Bloomberg Intelligence team. You know, Geetha, you called it on the subscriber numbers,
She
man.
did. She really did. Can you remind everyone what she told us a couple hours ago?
You said it was going to be a much higher number. It is a much higher number. Walk us through the quarter, and why is it that, though, first of all, I'm assuming you're watching the stock in the aftermarket. It's down about 2.6%. It just has been bouncing around a lot. Walk us through the quarter and maybe why you think, should investors be disappointed here?
So absolutely right, Carol. It was a blowout quarter. I think it came in much higher than expected. We were kind of thinking maybe $7 million subscriber ads, net ads range. This was, of course, way above that. But I think what is really kind of causing a little bit of concern here is that they are going to stop reporting subscriber metrics altogether. And that, I think, is coming as a little bit of a disappointment. I mean, Netflix is out and out a subscriber story, or
Yes.
at least it always has been. And so this is kind of going to require a complete change in the mindset of investors, right? This was always such an easy model to follow. You just multiply subscribers by the monthly price that you pay, and you kind of have your whole model. But now they're going to stop reporting subscriber numbers. They're going to stop reporting the average revenue per user. So it's kind of going to, it's definitely becoming I would say it's gone from kind of high growth to now more, definitely a very profitable company, but obviously they do seem to be kind of signaling that subscriber growth, the party is going to be over at some point.
Correct me if I'm wrong, Geetha, but did Netflix used to report churn and then they stopped reporting churn? And that was a really big deal to investors when that happened?
That was a very, very long time ago. Yes, they did. They would mention it, and yeah, they did stop reporting it. But subscribers, again, this is the bread and butter of this whole streaming business. So I think it's definitely going to require, people are going to take some time to kind of digest that.
Geetha, we've seen they have started to give us a little bit more viewership information over the past year or so. Do you think that is part of, or them kind of trying to signal that, ads are going to become a bigger part of our business? And, how big of a part of their business do you think that will be in the next couple of years?
Yeah, so right now they haven't really given us any concrete metrics around advertising. I mean, other than the first number that they gave us in January, which was roughly about 25 million active users. They did report something today by saying, that they've seen like 40% of their new signups are actually on the ad tier, but we don't actually have a concrete number. That said, I think what they're doing, they're still kind of taking a pretty measured approach. But there are signals that they really are looking to get or to scale up their advertising business. And I think sports is obviously a big way that they're going to do that. We obviously saw the WWE deal. There are a few more things that are out there on the horizon, obviously the NBA being a big one. And if they make an aggressive bid for that, then that really tells us how serious they are about advertising. And I think potentially what we're looking at in terms of advertising dollars, if they get everything right, it has been a little bit underwhelming so far. But if they're able to execute with the sports and the other live events, expect it to be at least 10 to 15% of their revenue by 2025. So, you're looking at a $45 billion business. I think you're going to see $4 to $5 billion at least in advertising.
It is kind of interesting. And, Geetha, we all kind of kid. It's like, I only have so many hours to watch all this stuff. And so we're picking and choosing. And it seems like there's so much out there. I mean, the company said in their letter to shareholders, with more than 2 people per household on average, we have an audience of over 500 million. And then they go on to say no entertainment company has ever programmed at this scale and with this ambition before. But it does feel like, and listening to you talk about, them not reporting their quarterly membership numbers in the future, that they are conceding that there is just a point that we're going to max out. We can just only sign up so many people. And that means even on a global scale, right?
Yes, on a global scale. So back in the day, maybe even about 3-4 years ago, they would always talk about this 1 billion number as their total addressable market. About 2 years ago, that's when the great Netflix reset and the great correction happened. They kind of toned that down. They said, it's probably closer to about 400-500 million as the total addressable market. Looks like it's, probably even slightly smaller than that, So they definitely are conceding that there is an upper limit. There is a ceiling to kind of the growth here.
But is there something like, I always laugh about this sometimes when we talk about some of these big tech names. We used to talk about this a lot by Apple. We'd be like, oh, it's a disappointing number. Yet they still sell a lot of stuff. And I understand its growth trends and trajectory. Can we still, though, concede that Netflix still is kind of the big behemoth in this space?
They absolutely are. They have completely cemented their dominance when it comes to this whole streaming wars. I mean, I think the streaming wars are pretty much over. They are the winner. There's no doubt about that. And now it's just about them kind of, getting into different verticals, kind of becoming that one service. They probably will, kind of absorb a lot of the other smaller streaming services, I think, just because they're licensing so much of content from them. And they, it's just, but at this point, it's definitely going to become, how much pricing power do they have? So right now we are at about $15.50 for a standard plan in the US. How much upside is there? Can that go to $20, $25?
Yeah.
That is kind of the big question.
So it's funny, as you're saying this, I'm thinking to myself, okay, well, 20 years ago, all we wanted was a la carte options for TV, and we kind of got that now. And I think a lot of us are spending more on all the combination of all these services, given that, it's Paramount, it's Hulu, it's Max, it's Disney Plus, it's Netflix, just to name a few. I do wonder, Geetha, where the growth is for Netflix at this point. Is it in the ad-supported model? Is it outside of the United States? Where is that growth coming from as the company matures? Is it raising prices?
Yeah, it's actually, Tim, it's all of the above. And it's just, it's going to be it's a very tough balancing act for them, because they don't want to do anything too quickly and too rashly, which is why when they were kind of implementing their whole password sharing crackdown, they were very careful not to raise prices, because, they didn't want to anger, existing customers. So again, it's going to be tricky. They're kind of walking a tightrope here, but yeah, they are going to use all the different levers that they have to kind of keep profitability, which is their main metric right now, profitability and margins, kind of climbing up.
Geetha, before the report and the analysts I was speaking to, a lot of them made a big deal about the T-Mobile partnership that they were working on. How do you see that factoring into the future? Do you think that has been a successful program, and can you expect to see them maybe do some more types of those partnerships?
Absolutely. I think that is going to become a critical factor for Netflix if it really kind of wants to grow its subscribers. So what they did with T-Mobile was kind of, they're offering their ad-supported plan, which is the $7 monthly plan to select T-Mobile members for free. And they're going to do a lot more of that. The having a low-priced plan kind of really gives them a lot of flexibility, because they can add subscribers, but then again, they're not necessarily losing ARPU, because remember, the greater the subscribers they have, they can always kind of appeal to the advertising community, so and kind of make up or offset for any of that ARPU differential from their advertising dollars. So I think that's going to definitely play a much bigger role, not just in the US, but of course across the world as well. They're going to have lots of those kinds of telecom partnerships.
Geetha, what do we kind of pull from this when it means to like Disney streaming and Warner Brothers Discovery and some of the other services that are out there?
So for all of those other services, I think subscriber growth is not the primary focus anymore. It's kind of moved now, Carol, to profitability, where obviously, again, Netflix leads the pack. A lot of these other services have made good progress, I would say really good progress when it comes to at least they're not profitable yet, but they're moderating their losses. Disney obviously is the big one to watch for there, and now they have the model in place. You've seen exactly what Netflix has accomplished. They all know exactly what they have to do. It's just going to be a question of how well they do it and can they get there quick enough.
Geetha, do you think there's any consumer confusion? I mean, okay, I know the answer to this is yes, and I just don't know how to solve it. The consumer confusion about where to watch something.
Yes.
You mentioned Sex and the City, and I was shocked to hear that that's on Netflix. It's an HBO show. Somebody in our simulcast chat mentioned The Office. Well, I think that's now on Peacock, but it was on Netflix. Friends, a former NBC show, or no, Seinfeld is now on Netflix, I believe.
It's confusing, see?
Right? Is that right? I don't know.
It is.
How
Discovery is the big. It's not content
talk about
anymore.
this.
It's really just Discovery is the biggest problem right now in the whole of, the streaming space. And at the end of the day, we're kind of looking for that one. Or what we're waiting for is that one aggregator or re-aggregator that can kind of take all the shows that you really want to watch and do it. I don't know who it's going to be. Is it going to be YouTube? Maybe it is. It could be Amazon. It could be Apple. But we're all waiting for that. Again, not sure when exactly it's going to happen.
Roku does a really good job of that, but you got to be signed into everything on your Roku, and plus that means you're only watching on TV. You're not watching it on the iPad or on your phone.
Well, I know
there still is friction.
Yeah, there is still a lot of friction.
Final thought, Geetha. I'm just thinking of our investor audience as we work through this. Netflix shares still down about 3.25% here.
Yeah, so I think the big question is really going to be, on the call, how many subscribers or how many, subscribers do you think you've captured from the whole password sharing initiative? I think the number that they originally identified was 100 million households. I think people will definitely want to know what percentage of that has already been kind of captured, just given the strong subscriber metrics, and then they'll kind of try to figure out how much more runway is left.
Rockstar, as always. Geetha Ranganathan, thank you so much. Tech and media analyst at Bloomberg Intelligence. Red Brown, final thoughts for you, just 20 seconds here. I mean, stock's down in the aftermarket, but we'll see what happens tomorrow.
Yeah, we'll see what happens tomorrow. And for the remainder of the year, I think, they put up strong financials and that could easily bounce back. There's quick reaction, but investors love the short term.
And also depends on what they say on the call.
Exactly. And it'll be interesting to do if some investors might say, well, wait, it's a little bit cheaper than it was. And I want the exposure. Red Brown, thank you so much.
Also a rock star, Red Brown.
Yes,
Thank
indeed.
you for sticking with us.
It's kind of a
really
rock group here right now.
Yeah, we had a great group.